Welcome back. In less than 2 hours, Ben Bernanke will be giving remarks in Jackson Hole. Our next guest says there will be no hint of further stimulus. Joining us is David Semmens. He is the U.S. economist at Standard Chartered Bank. David, you say we're really not going to even hear a word, right?
No, I mean, what we think he's going to be pointing to is we're going to say that there will be stimulus, but just now isn't the time. He's going to lay out exactly what he sees coming, but we're not expecting him to announce explicitly QE3. He's going to lay out the conditions that are necessary, and those, unfortunately, are not being met. We're still seeing inflation trending up at the moment, and until inflation comes down, he's not going to be able to appease everyone on the FMC that now is the time for further easing.
David, what are the chances he hints at something, let's say, slightly less dramatic, that is to say, buying treasuries on the long end, for example?
I mean, we think that would be the next logical step. We think it's very likely he's going to hint towards that, moving from the 5 to 7 year more into the 10 and perhaps even out to the 30 year, because obviously we've seen a very steep decline in the 10 and 30 year yields over the last couple of weeks.
Our economics editor told me that was done in 1961 and sort of the twist, right?
Exactly.
Okay, so we should look for clues for that. What do you think, David, that Bernanke is going to hint that he needs to see before anything more dramatic than twist has to be done? I mean, unemployment's already at 9%. How much worse does the economy need to get?
I mean, I think he really wants to be reassured that the inflationary uptick we've been seeing is purely transitionary, and also you did have 3 dissenters at the last Fed meeting, and that's obviously very concerning. He wants everyone to be on board before they enact further QE, but we think it's actually going to be coming in the first quarter of next year, because you're going to see base effects really driving inflation coming lower in the coming couple of quarters.
To your point, David, I didn't mean to cut you off, but inflation, we know, rising around 2% this year, which is extremely different than the picture from last year at this time, where deflation was more of a concern.
Right, exactly. This time last year, we were having the same weak economic conditions. Unemployment was still high, but this time last year, people were getting very worried about deflation. We saw CPI come down to 0.8, and you saw a big decline in the 5-year break-even forward, and that's what really was driving people's concern. Deflation is far more of a concern than inflation, because it's far more difficult to turn around a deflationary spiral.
So now, David, I heard what you said, that you do think that another form of stimulus is coming, but intended for the first quarter of next year. What do you say to all the people out there, all the economists even, who say this is not going to help the U.S. economy one iota, it's still not going to help growth, and that at this point it's Congress that needs to act and not the Fed?
Well, we're going to be seeing fiscal cuts from Congress, so it's really up to monetary policy to do all of the heavy lifting. And this is really the best course of action for the Fed to take. They are doing everything that they can. We think that the policy that they will announce will be very aggressive and very strong, and they have been a much more of an earlier leader than Japan was. When you saw the deflationary concerns in Japan in the 90s, it took a much longer time for them to act. The Fed has acted very quickly. This will be the third round of stimulus that we have had from the Fed.
To your point, David, we were even speaking with Richard Koo from Nomura's Institute earlier, and he's pointing out a lot of what you are, in that you can't take away sort of support when individuals are deleveraging. What about this argument, though, that if we do see another round of stimulus, QE3, that it's going to inflate stock market values, for example, far beyond what the underlying value represents?
Well, the inflation of stock market values does have a positive effect for the economy overall, because it's obviously the wealth effect which feeds into consumer spending. So although that's not really going to be the aim of the policy, it is going to be a nice second round effect for the Fed to take some comfort from as well.
But you don't think that that upsets analysts who say that they're not, quote unquote, real gains?
I think the Fed is really focused on the long-term good for the US economy. I don't think they are concerned with upsetting analysts in the short term.
Well, fair enough point. David, thanks so much. David Semmens joining us there. He is from Standard Chartered. He is the U.S. economist.